Most billionaires diversify their risk. One man multiplied his. At one point, if 3 rockets failed, 1 electric car company slipped, and a bank payment deal collapsed at the same time, Elon Musk would have been personally bankrupt. That wasn't a metaphor, that was the actual math. And that's the uncomfortable starting point. The world's most famous entrepreneur didn't build his empire by avoiding risk. He built it by stacking risks so high that failure in one could trigger collapse in all. That matters right now because people don't just watch him, markets react to him, governments negotiate with him, entire industries price themselves around his decisions. Understanding how that power was built isn't curiosity, it's financial literacy. The story doesn't start with rockets or cars. It starts with a simple question: how do you turn ownership into leverage? In the late 1990s, he co-founded Zip2, a city guide software company most people have never heard of. It sold for about $300 million. His cut was roughly $22 million. Not billionaire money, just enough to play the next game. Instead of diversifying, he went all in again. He put most of it into an online banking startup that later became PayPal. When it sold to eBay, his payout was about $180 million. Here's where the pattern begins. Most founders who cash out become investors. He became a concentrated owner. He split that money into 3 high-risk bets simultaneously: rockets, electric cars, and solar energy. Rockets first. He founded SpaceX with a goal that sounded like science fiction: reduce launch costs enough to colonize Mars. The first 3 launches failed, not underperformed, failed, exploded. Each one cost tens of millions. By the 3rd failure, the company was nearly out of money. Then something strange happened. Instead of walking away, he doubled down. He used his own remaining cash to fund a 4th launch. If it failed, the company would die. It didn't. That success triggered a contract from NASA worth billions, not because the company was safe, because it was cheaper than competitors. Cost advantage beat reputation. Now shift to cars. When he joined Tesla, it was not the giant people imagine today. It was a fragile startup burning cash while building a product the industry said nobody wanted: expensive electric cars. In 2008, during the global financial crisis, Tesla was weeks from bankruptcy. Simultaneously, SpaceX was nearly out of money. 2 companies, 1 wallet. He split his last funds between both just to keep them alive. This is the hidden mechanism most people miss. His empire wasn't built by safe wins, it was built by synchronized survival. Each company had to live long enough for the next one to unlock funding. When Tesla survived, its rising valuation became collateral, not literal collateral in a bank vault, market collateral. His shares increased in value, which increased his borrowing power. That's the real engine behind the empire. He rarely sells his stock. He borrows against it. If his shares are worth 100 billion, banks will lend billions using that stock as security. That borrowed money can fund new projects without selling ownership. Ownership stays, power stays, control stays. That's how he financed ventures like Neuralink and the Boring Company without needing them to be profitable early. It's financial engineering disguised as entrepreneurship. But this system has a pressure point. Borrowed money tied to stock value only works if the stock stays high. If it drops sharply, lenders can demand repayment or more collateral. That's called a margin call. And margin calls don't care about ambition, which brings us to the acquisition of X. He didn't buy it with cash sitting in a vault. He used a mix of loans and Tesla stock as backing. That means fluctuations in Tesla's share price could influence the stability of a completely different company. That's not just business, that's interconnected leverage. There's an irony here. The public narrative says he's unpredictable, but financially his strategy is consistent. Concentrate ownership, use that ownership to borrow, deploy borrowed capital into new high-risk ventures. repeat. It's a flywheel powered by valuation. And valuation isn't just numbers, it's belief. Investor belief, market belief, public belief. If belief rises, valuation rises. If valuation rises, borrowing power rises. If borrowing power rises, expansion accelerates. Confidence becomes fuel. But hype and reality aren't the same thing. Take Tesla. For years, critics argued its valuation made no sense compared to traditional car companies. Yet the market kept pricing it like a tech company, not an automaker. That single perception shift added hundreds of billions to its market value, which meant more leverage capacity. That's the uncomfortable math. His empire isn't just built on products, it's built on perception of future dominance. Markets price what they think will happen, not what already exists. And that creates a paradox. If he succeeds, the valuation was justified. If he fails, it was a bubble. But until failure happens, the system keeps rewarding expansion. Regulators have noticed. The SEC once charged him over tweets that moved markets, because when a single statement can shift billions in valuation, words become financial instruments. Zoom out, and the pattern becomes clear. Traditional industrialists built empires by controlling factories. Modern tech founders built empires by controlling narratives about the future. One owns production, the other owns expectation. Expectation is lighter, faster, more volatile. That volatility is both his weapon and his risk. Because if multiple companies depend on the same underlying asset, his reputation and his flagship stock, then a shock to one can ripple through all. Not immediately, but structurally. It's like a skyscraper supported by one central column, efficient, elegant, dangerous. Supporters call this visionary leverage. Critics call it systemic fragility. Both are true. And that's why his empire fascinates economists. It's not just big, it's architecturally unusual. Most corporate empires diversify risk across independent cash flows. His links them through ownership and market valuation. It shouldn't work as well as it has, yet it has. Which leaves one final question investors quietly wonder but rarely say out loud. If the system depends on belief, what happens if belief changes faster than the numbers can catch up?